Hello, I'm Mark, and we are going now into the part 3 of option strategies, which involves the straddle and strangle strategies. So, have fun! As per definition, a short straddle is a sell, a call, and a put within the same expiration and strike. So in our example, I took a US deal in selling a call 124 and the put 24. You can see here the prices. You can see that the volatility is 64 and the expiry is on the 12th of May. This is a kind of 2 weeks option I did, and I would get 230 more or less, or here 225. As I said, there's always a bid and ask, so you probably can put in between the credit and maybe wait 5 or 10 minutes to be executed, and then you get this point, these prices. I sum up the break even. In other words, I use this credit in reducing from 24 and in adding to 24, so you have a kind of wide range for the next 2 weeks. We need to add that US Steel just brought some earnings, and I did a case study about it because you can see that whenever you do short straddle and short strangle on options which expires in 2 or 3 days, it's really a big movement in volatility. This one actually, as it was 2 weeks, so the volatility has not moved that much. What is possible too is to do a long straddle. In order not to sell a call and put option, you could buy a call and put option, and then it would result a debit of 157, or let's say here around 160, knowing that the break even must be outside this range to earn some money. I would recommend this strategy definitely when it comes to these so-called meme stocks, or these stocks who really have big movements. Obvious, they are probably very expensive. You can see here the volatility that it went up over 100%, and then it's obvious that you pay much more. But we should expect too that maybe not with a US deal, but let's say with stocks like AMC or stocks like Snap, that they move right away 20%. So in other words, you may pay a premium, but because of the huge movement of the stock, it would even be paid out. Or we take an example of Meta, the Facebook share, who actually went up by 13-14% the next day. So definitely a long straddle would work out, because the expectation was maybe a move of 2 or 3% on each side. But when you get 13%, then obviously you can be sure that you get a really nice profit by buying those options. So as a per definition, a short strangle is the selling call and put option with the same maturity or expiration but different strikes. And this is probably a bit more comfortable in a way that you don't sell at the money, you sell maybe a bit outside, and you get a bit more room, let's say, that your option doesn't get exercised. I mean, I have here an example that I opt for the 24.5 call to the 23.5. At the moment, the stock was trading around 20, almost 24. So the system would propose you right away a kind of short strangle, where in the middle would be more or less the actual price, and then they propose you, let's say, an option of 2 weeks, and then you still can adjust the strikes, or you can adjust the width, which we can see with one of the next print screens, or as I said, you can do again the expiration. So in other words, it's the same as a straddle in a way that you get a credit on both sides. You can add it or deduct it to the break even, and the price expectation you see is from here, that when they say there's a 64 volatility, okay, the stock price would move around 2. So you can see now that you get only one, let's say 170, but the expectation could be 2. So it's certainly not too bad if you may find a strangle which actually would cover in amount more or less the price, the fluctuation of the stock. Here I have another short strangle example of selling a call and a put with the same expiration but different strike. I did this print screen because of the earnings of US Steel. You can see that the volatility is very high because this is just one day upfront the earnings, which I wrote here. So in other words, that what I did, I extend a bit the spread, but I still get really nice return or premiums of 56 more or less, meaning that on each side I have again a kind of protection. It could go down to 22.46 from the 23.99, so there's really a huge gap I would have, and this is certainly interesting whenever doing a short strangle, that you could really extend or go a bit far from the current actual price. As you can see, it's about 1.5 on each side, which I have tried, or even, oh well, here it's about 2 and the other one has 1. So you can again adjust your strikes, but it's obvious that the higher, lower you go with the strikes, the less will be the premium. But seeing sometimes those stocks moving by up or down 20%, it makes sense maybe to get a bit less premium, but being a bit on the good side, that you don't get exercised. So you may do the same on the long side. You could buy a long strangle by buying a call and a put. Let's say here is again the 24.5 to 23. So you bought, you pay for both 111, meaning that your break even is always you have to go further down to 22.35 or 25.35. So again, this would only make sense that you expect a huge movement of the stock, again minus 20% or minus 15%, because you paid already quite a high premium for it. It's like you pay the risk, or let's say you pay for something that you expect it must move. So if not, this amount the next day would come really drastically down to maybe 50 or 40 cents if nothing happens to the stock. As I said, I did a case study. If you check on my videos, the case study, it would show you the previous day, the day after the earnings, in using these kind of strangle and straddle strategies. So far done part 3. You're going to see here part 4, or the case study of US Steel. So just feel free to click whatever you like. I hope you have enjoyed and hope to hear you and see you again. Bye bye for now.